So, Louisiana-Pacific, you probably know them as LPX, just reported their third quarter earnings, and it created this total paradox. The company actually raised its full year profit forecast, which you'd think is great news. But the stock, it got absolutely hammered. So, what on earth did the market see that the headlines missed? Let's break it down and get into the real story behind this sell off.
And here it is. This is the whole story in just one number. On November 5th, the day they had their earnings call, LPX stock just cratered by more than 8%. I mean, this wasn't some minor dip. This was a massive vote of no confidence from Wall Street. And the big question is, why? Okay, here's how we're going to tackle this. First, we'll hit the headline numbers. Then, and this is the important part, we'll get into the huge split between the company's two main businesses. One is just soaring, the other is sinking fast. After that, we'll look at their guidance and a surprise change in leadership. And finally, I'll give you our take on what really matters for the next call.
All right, let's start with the raw numbers. You know, the stuff that flashes across trading screens and causes that immediate gut punch reaction from investors.
Now, if you only looked at the top two lines here, you'd probably be scratching your head about that 8% drop. Revenue, basically right where everyone expected. Adjusted earnings per share at 36 cents? Okay, it was just a penny shy. No big deal, right? But then you get to the GAAP EPS. They reported 13 cents when the street was expecting 51. That's not a miss. That is a complete cratering, a nearly 75% negative surprise. Ouch.
And this chart just lays it all out, doesn't it? It perfectly shows you that huge chasm. You can see how the adjusted number, which, strips out some items to give a cleaner look, was right there with what analysts predicted. But the GAAP number, that's the official, by-the-book accounting figure, it just completely fell off a cliff. And for a nervous market, a gap this wide is a massive, massive red flag. So the bottom line is this. The market totally saw past the stable revenue and the kind of okay adjusted earnings. It just honed in on that massive gap miss like a laser beam, and the stock paid the price for it. Simple as that. So why the huge miss? Where did that come from? Well, to find the answer, we have to crack the company open and look inside. Because right now, LPX is really a tale of two completely different businesses. One is absolutely booming, and the other is dragging the whole ship down. And here it is. On the left, you've got their siding business. This thing is the company's rocket ship right now. Revenue's up 5%, and it's spitting out a really healthy $117 million in adjusted EBITDA. But on the right, you have OSB, or oriented strand board. It's a basic building commodity, and right now, it's just an anchor. Revenue plunged 29%, and the segment actually lost $27 million.
And listen, this strength in siding isn't just an accident. Management is playing a great hand here. The CEO, Brad Southern, pointed right to their innovation, like their new ExpertFinish products, which saw volumes pop 17%. They're creating these high-value, branded products that have real pricing power. It's a great strategy.
But that OSB business, it is just wiping out all of that good news. To put it in perspective, that negative $27 million figure, it represents a $60 million negative swing from the positive $33 million it made just last year. Think about that. That's a $60 million anchor dragging the entire company's results into the mud.
So, okay, that was the story of the last 3 months. But markets, they trade on the future. So what did management say is coming next? Well, this is where the outlook gets even more worrying for investors.
Their fourth quarter guidance shows this painful trend is just going to keep going. Siding is expected to keep growing, which is fantastic, but look at OSB. Management is forecasting the EBITDA loss to get worse, widening to around $45 million. That's a huge signal that they haven't found the bottom for their commodity business yet, not even close. And here it is, the central paradox we talked about at the beginning. Despite that grim Q4 outlook for OSB, management actually raised its full-year profit guidance. The siding business is just so strong that it's more than covering all those commodity losses. But the market completely ignored it. It just looked at the short-term pain in OSB getting worse and decided, nope, that's the real story here.
And to throw another wrench in the works, there's a CEO transition happening right in the middle of all this. Just 2 days before this really tough report, the company announced CEO Brad Southern is retiring. The incoming CEO, Jason Ringblom, is going to inherit this strategic mess, and you can bet investors are watching to see if he's going to finally make a big move away from the volatile OSB business.
Okay, so let's put all the pieces together. We've got a thriving siding business, a money-hemorrhaging OSB division, and a new CEO about to take the reins. So what's our take on where LPX goes from here?
We're rating the stock market perform. Now, this isn't a call to run out and buy or sell. It's really just acknowledging that the stock is caught in this powerful tug of war, and it's probably going to trade sideways until one of those forces clearly wins out.
So here's the whole thesis broken down. The bull case is pretty simple. You're buying a fantastic, high-margin siding business that's innovating and winning. The bear case? Well, you're still shackled to this money-losing commodity business with no turnaround in sight. Our verdict is that the market is going to stay on the sidelines. It's going to wait until it sees a clear bottom in OSB or it sees definitive proof that siding is finally strong enough to break the chains of that old OSB cycle for good.
So, if you believe in that core idea that a really great business is being held back by a pretty bad one, how might an investor actually play that in the market?
Well, one potential strategy is what's called a pairs trade, and it's designed to capture this exact split. The idea is to try and isolate that successful siding story. So, you would go long LPX stock, basically betting that the market is undervaluing that great siding business. But at the same time, you would short a homebuilder ETF, something like XHB. You can think of that as a bet against the general housing market, because that's what's really hurting the OSB segment. The goal here isn't just for LPX to go up. The goal is for LPX to perform better than the rest of the sector. If siding stays strong while housing stays weak, this trade is designed to profit from that difference.
You know, the big question for the next earnings call will be whether the new CEO signals a more aggressive plan to fix or maybe even sell off the OSB business. Now that could be the catalyst that finally breaks this stalemate. And of course, we have to say, this is not financial advice.